A crowd-funded IPO is not new. It started in 1606 with the Dutch East India Company, and Disney's got 1 million shareholders. So what are we talking about crowdfunding? Crowdfunding is really internet investing. Use this one? Okay. Internet investing is really what we're talking about. This wonderful new tool that enables issuers and brokers to be able to reach an enormous number of potential shareholders, communicate with those shareholders, and actually sell stock on a website. And that is really what we're going to talk about today, because you can do that with an IPO. You can actually do an IPO, a fully registered IPO on the internet. It is my feeling that the reason we have this Jobs Act is because an S1 is too onerous. An S1 and a certified audit is required in order to do an IPO. And so they invented the Jobs Act to make it very easy. If you have an effective S1, you can sell to non-accredited investors. You can raise any amount of money. You're basically, Doug, if you want to comment on that, about if I have an effective S1, what can I not do as far as raising money?
I think your observation, Gene, is right. If you have an effective registration statement, whether it's an S1 or another form of a registration statement, you can generally solicit, not unlike Title II from that point of view. The only caveat there is, and it's similar to Title II, is that you have blue sky requirements to make sure you file in those states where those securities are to be sold.
So you still have to talk to the various states. But what if I'm a covered security and I'm going to be on NASDAQ? Doesn't that exempt me from a merit review?
Well, since this is obviously a Socratic conversation that we're going to have where you're going to keep adding various factors, yes, if it's listed, like New York Stock Exchange, and as David said earlier, NASDAQ ultimately became a covered, if you list on NASDAQ, it's a covered security, and therefore you preempt all 50 states, then that works. If you're a bulletin board, pink sheet company that doesn't work there, or for that matter on the dark markets, whether it's shares post or second market.
So I'm restricted from certain states, but I could effectively have an internet offering of my IPO and go out to the general public and sell to non-accredited investors.
Yes.
Yes.
Okay.
In fact, the first company in the modern era that did that was a company called Witt Beer, and it was run by a guy named Andy Klein. He was a corporate securities attorney, did it over the internet, and then created, people remember during the heyday of the internet, bubble Witt Capital, which was essentially trying to market IPOs online. It was essentially what their business was.
I did the audit of that. So, well, that brings us to you, Rich. In addition to an S1, you have to have a certified audit. You want to talk about what a certified audit is and what's involved?
Yeah, I think there's a more fundamental question here. It's the notion of how to access capital through the public markets, and whether you're doing an IPO, you know, an IPO includes obviously a banker, and the banker has their lawyers, and you have their lawyers, you have your lawyers. So, you know, at the end of the day, the financing it's a complex activity. It's not a simple thing to do. One of the elements of the initial public offering is the audit of your financial statements. And many of these newcos or these startups, there's not a lot to audit, but because an audit is governed by procedures that are prescribed by the government, if you will, today under something called the Public Company Accounting Oversight Board, they're costly. They're not inexpensive to accomplish. And in addition to that, and there are certain other activities and activities that are required where your auditor is going to have to interface with you. One is, in a typical IPO, it's called a comfort letter, which is a very comprehensive and extensive activity where the auditor gives comfort to the underwriter or to about certain information that's included outside the financial statements but in the prospectus. So there are a number of different cost drivers that are involved, and I know one of the questions Gene's going to ask me is how much does it cost to do an audit? I have no clue. It's a facts and circumstances kind of thing.
How big is big, right?
Yeah, exactly. So one thing I can tell you is that there's a cost. I mean, at the end of the day, when you look at the raise, the cost of raising capital, you have to assume that the professionals are not going to work for free. And so there is going to be a cost associated with that. The key point is how to minimize that cost, and obviously that you work with your professionals in that context.
I mean, actually, the Jobs Act itself was a number of the provisions in Title I of the Jobs Act were intended essentially to shift some of that cost out into the future, so that you, for instance, with testing the waters, you can determine that the deal is viable before you incur a lot of that expense.
Right. Right. I mean, but you know, at the end of the day, what David's speaking to is this notion of the process of taking a deal through the economic accomplishment of raising the funds, and that works for companies who are fairly large. What I'm concerned about is smaller companies with crowdfunding. Once we're allowed to do it, if you raise $1 million, and the lawyers will tell me this, correct me if I'm wrong, you need an audited financial statement. Now that's a challenge, because you could be a company that has really no operations, but there's still a basic process that you need to go through that's going to be a cost driver, because the auditors are not allowed to do the work for free. They can't take contingent consideration because of the independent standards. So there's essentially a cost, and that's an annual cost, if you will.
Gene, can I jump in for 1 second? And I'm sorry that Rich doesn't want to do things for free. I think it would just be very helpful to the cause if he would volunteer. And I know I've already satisfied my pro bono obligation with crowdfunding. We're talking about we're all struggling, I call it rules arbitrage, to figure out the best way forward in order to accomplish what you're trying to do. And Gene's thesis here, which is a direct public offering, utilizing some of the current technology and skill sets through crowdfunding platforms, is fascinating, but we're trying to balance a series of issues. So what you get from Title II, which is the lifting of the ban on general solicitation, so now you can market all you want to the world, so long as you only take money, as we talked about earlier, from accredited investors. Well, Gene doesn't like that. He wants to be able to market to unaccredited investors.
And I'll tell you why, because the 4 things that they're requiring, one of them, I got to send in a tax. Let's pretend I'm an investor, and and I'm accredited, and I want to invest in something. I got to send in a tax return. I got to do all that. I can't just check a box anymore. Not only that, but the issuer has to file his marketing materials in advance with the SEC. And it's going to be a much more complicated form, from what I understand.
I wasn't arguing.
So it's not going to be.
I was just merely making an observation.
No, but it's not going to be the picnic that everybody thinks it's going to be.
But let me just round it out for you, because first of all, the bit about the 15 days in advance is a proposed rule, and I think there's going to be a lot of industry pushback to that.
That'd be good.
And the asking for the tax returns, in my judgment, again, because people are being asked, will be able to put up a lot more money, isn't such a big deal in exchange for general solicitation. But these are all different tools and pathways and decisions that an entrepreneur needs to make in order to determine what's right for them. And so Gene's thesis on a direct public offering through a crowdfunding platform is clever, but it has higher transaction costs. And in exchange for the higher transaction costs, you are further along in terms of actually being a public company, having the liquidity that Doug Atkin and David talked about earlier. And you can market generally across the country so long as you comply with your blue sky filings. But it's probably not for a startup company. It's for a more mature company that actually has the means by which to pay for Rich, hopefully pay for me as well, and pay the commissions for the broker-dealer in the process. So it's just another approach to fundraising that, broadly speaking, it's crowdfunding, because the crowdfunding platform will be a channel of distribution for the sale of the securities to both accredited and uncredited investors. And I just want to make sure that that point was made.
I have a question for Bruce. Now, Bruce, you're a FINRA broker with, what, 140 brokers around the country or something like that?
Yes, I am.
You've been a FINRA broker for 20 years, and you know a lot about this field. Would your firm be interested in an internet offering with 1 million shareholders that only buy 1 or 2 shares, let's say, and why would that be of interest to you?
Well, actually, as a broker-dealer who is commission-based and underwriting-based, when you hear something like 1 million shareholders, people investing $10 or $20, you say, where's the profit potential in that? I think what's going to happen here is we would be interested in doing this on the level that, just like people go out and solicit new investors, whether it's through mailings or cold callings or giving conferences and dinner invitations, they're actually looking for the diamond in the rough, or they're looking for that one investor in 1,000 that is going to make them profitable, and that's what you get paid for. That's the art of selling, really. You get paid for all the people who basically say no or don't really make you any money, because in there you find somebody who
In the 1 million shareholders that log in and fill out an account, you're going to find a few pearls.
That's correct.
Yeah.
And yes, we would be interested in doing it, and Gene, you and I have had many discussions over this, and I think the internet IPO is something that really, I know I've wrestled with this to the respect that we want to make sure that if we were involved in one of the initial ones, or the initial one, if you would, is that we'd find something that really truly has an affinity group that is going to be attracted to this. And I draw the example of when Facebook came to marketplace, and everyone knows the story of how maybe it came too late and all the real money had been made by private equity firms. What we would be looking for is for a firm to say, you know, had Facebook or possibly a Twitter, that's a company that's got 600 million users, or in Facebook 1 billion users, well, you could have funded those IPOs with every user putting $2 into it. And they could have raised, Facebook could have raised the same amount of money through its investing group, people that are using this product every single day. So trying to find companies that fit in an affinity marketing group who also will really be the challenge here. We're talking about something that is marketing driven, as opposed to, you know, I don't know that it would work for a widget company. Who wants to buy this tool that makes this wrench? Well, if only carpenters use it and the rest of the world doesn't, I don't think that fits.
Works better for fans. I got a question for you, Rich, but I want to ask David about something, a similar line. In a major underwritten IPO, you know, we had talked about it being some component of an IPO that an underwriter could use, and use the internet to go out to a certain group and possibly do this. And the question would be, you know, you had, in your earlier talk today, you had talked about the concern for the brokers being disintermediated and losing their jobs and not being able to make any money on it. Can you address the use of the internet in offerings by any of the major brokerages? Would they ever find that appealing?
Well, I think they have, and they will in certain circumstances. And Wall Street set up. One of my friends ran equity capital markets at Citibank. Was telling me they put out 2,000 pitches a year. You know, that's a bulge bracket firm, and their focus is on maximizing economics to self. They're in the heavy throughput business. They have a major institutional sales department. They look at things and they vet them first and foremost on the basis of whether or not they think they can get those deals done. And so, when you start to look at things that add to the distribution, there's usually a reason why they kind of go off their sort of standard, and it's usually because the issuers push it on them. I mean, a classic case that didn't work out well was the Vonage IPO, where Jeffrey Citron, who was the CEO, wanted to take 15% of the shares and have them allocated to suppliers and all sorts of people. It was an affinity marketing deal, and that piece of it was poorly managed, and in fact a lot of the shares I think weren't confirmed and ticketed, and I think that there were some fines that were meted out as a result. But that said, is that Wall Street has a process today. They will modify the process if the issuer asks them to. The instances where issuers will ask them to do things like that, or where there is a natural affinity group. It might have been something that would have been interesting to do with Facebook, with LinkedIn,
Twitter,
all the social networking stocks. Yeah.
So now, Rich, we had
Gene,
talked about.
Gene, can I add to that for 1 second?
Yeah, sure.
I think the only thing I would add is that with this new world of funding platforms for Title II and Title III, which really hasn't existed, even though there have been underwritten offerings, as David's pointing out, that do have an internet component. I think as there are niche players that evolve over the next several years, Title III platforms in particular, if they happen to be broker-dealer funding platforms, because a funding platform under Title III doesn't have to be a broker-dealer, but if it is a broker-dealer, I do think some of maybe the medium-sized firms may see those funding platforms as interesting channels of distribution and could absolutely add them into their syndicate and include them.
I had a question for Rich. Rich, we had talked about, let's pretend I do a direct public offering. I'm an issuer, and it's very successful. It's got a FINRA broker. Everything's all by the book and everything. And let's say I'm invested in that. How do I know the value of the investment? Number one, how do you value these direct public offerings? Let's pretend it might even be a startup company or something, number one. And then number two, how do I make a profit on my investment?
Yeah, that's been my concern from the get-go, especially when there isn't a market maker setting values and there's without a liquid market. Obviously, in the public company arena, there's a market for it. There's a trading platform that you can buy and sell, which will indicate value. That's not the case, and in these fundamental private offerings. Even a crowdfunding is a private offering for all intent and purposes. It's an offering that's exempt from registration. The issue there is information. What is my company about? How transparent am I to the shareholder to allow those individuals to make informed decisions? So even in the Reg Ds, where audited financial statements and documentation is not necessarily required, you need to be able to give the marketplace information so they can make a value judgment. There's no doubt about that. And the point I want to make, and I'll get to liquidity in a minute, Doug made a good point. At the end of the day, you got to pick and choose the best method for your raising of capital. The raising of capital is a tactical response to some strategic need. And you can't just assume that it's a one-size-fits-all. You have to really sit down and evaluate what is the best source of capital for your company at that stage. And it's not just, you can't read the headlines. You have to really make a serious evaluation with your advisors, because no doubt the legal issues are very profound. You need banking counsel, because bankers are the ones, I don't know how not to get a banker involved in selling. We were talking to Gene and I, and Bruce met with an attorney to do a DPO, or talk about DPOs, and the first question that comes to mind is, who's going to market it? How does it get sold? Who's going to manage the shareholder activity? We're not bankers. That's not what we do for a living, so you can put people at risk without considering that. And I guess the last point I've always asked is, how do I get out of this stock? If I give my stock to my employees because, it's a currency. That's why I'm doing this, right? I'm creating another valuable currency in my organization to be able to achieve my business objectives. What do they do with it? So Dara talked a little earlier about second market and some of the other, is that liquid enough for them? Does that make sense? That's where I think some of this, David and I coming to here from the airport talked about the 2.0 version of Jobs Act. We got to create some kind of liquid market for this stock, so it in fact could behave the way it should behave, and then that way you really be able to come up with values that are transparent and realistic in terms of the businesses.
One last question for did you have something to say?
Yeah, Gene, I'd like to add to that. This valuation, it's incumbent upon the investment bank or underwriter to come up with that valuation, either through comparables with other companies, whether they be public or private. And I view the banker, we've talked about a number of things and discussed with many attorneys, companies going public who are private and doing it as a direct placement from the company and not using an underwriter. That's a possibility too. Companies like Ben & Jerry's Ice Cream started that way. Costco. Some very interesting companies have actually started that way. However, there is a point where do you have the team in-house to do that? And isn't it better to pay someone to quarterback the situation for you,
sure,
so that you have the proper valuation, so that the proper legal team is put in place, and somebody who's ultimately accountable from a regulatory standpoint for what's been done? That's what the purpose of your broker-dealer / underwriter is.
I would bet that Costco and Ben & Jerry's, though, they might not have used a broker, but they probably used attorneys and accountants.
Well, I'd like to say one thing myself about valuation. Two boys, marketing fellows, were sitting around drinking Pabst beer one day, and they had heard that Pabst Beer Company was for sale. So as a kick, they said, you know what? Let's see if we can crowdfund and buy Pabst beer. And so they started a website called buyabeercompany.com, and they they didn't sell anything. They got pledges for $282 million on the website to buy Pabst beer before the SEC shut them down. And not one of them, I'd be willing to bet you, not one of them was concerned about valuation or the exit. They just wanted some Pabst beer.
Right. I have to say I was intimately involved with the wheat beer, and that actually evolved into an online brokerage firm. Unfortunately, didn't make it. But that was a mess. We didn't have a banker. It was Andy Klein, who was a great attorney, bright guy. We didn't have a banker.
He was a corporate securities attorney by training, right?
Exactly, right. Yeah. A brilliant kid, and me, from Arthur Anderson, and thinking, this is the greatest thing since sliced bread. We had not a clue. It took the time we got through spending on the blue sky responses, speaking to and meeting with the people from the state over financial statements that had less than $100,000 of revenue in it. It was unbearable. So it wasn't then, I'm not sure it is now, it's not an easy process. And you really do need the advisors to make sure that you're positioned properly to be successful.
Okay, but one last thing for Doug. Doug, if I've got an effective S1 and a certified audit, and I make that prospectus available on a web page on my website, and I have a link to that so that they have access to the prospectus, is there any limitation for me with social media marketing to drive people to that prospectus page to sell the share of stock on my own website?
It depends. There are different types of deals get different treatment. So presumptively, no. You should be able to do all
effective
of that.
S1.
There's a thing called a free writing prospectus that has some limitations.
Well, this is an effective one.
I understand. So I'm saying, generally speaking, yes, you're okay.
Yeah.
And that's just like Title II, where you can generally solicit, and you can get investors any which way that you can. It doesn't answer or respond to the questions on how you establish value, but lots of private placements are direct issuances from the entrepreneurs without advisors. Again, I'm not recommending it. It does go on all the time. You do run the risk of down rounds later on, potentially. And if you're in the full disclosure business, as I am, then you just have to highlight those risks that you haven't engaged an underwriter, a placement agent. Maybe you hire somebody who does valuation work for you.
No, I'm assuming you'd have a FINRA broker working with a FINRA broker that's a policeman on the deal.
Yeah, then you should be fine.
Okay. Anyone else have a comment? Because I know they've got a couple of questions and we're up against lunch here, so.
I just wanted to, thematically, one of the things you heard here is where people are struggling. There's many different ways to create demand for offerings, right? This is about demand creation. And you can do it through brokers. And Bruce's firm's got 140 of them. They can make phone calls and deal with their clients. That's a way of doing it. But a lot of what you're seeing over the internet that's successful is stocks can create their own demand through their own brands through consumer-philic products, right? And so you've got a continuum here, which is the hot, sexy, interesting kind of things that people relate to on the one hand, which are easier to get done in these kinds of new modalities, and then the intangibles, which are things on the other end of the spectrum, like the biotechnology companies. And so they're going to still need, in all likelihood, people that can go out and do much more high-touch positioning to support them, not just on the offering, but in the aftermarket. And so I think you're going to find that the types of things that can get done over the internet through the affinity marketing are going to be a somewhat narrow swath of total enterprises.
Okay. I think we got a time for just a few questions. If we, gentleman right there had his hand up first, right there on the end.
As a possible means to meet the number of shareholders one needs and the other requirements to get listed in NASDAQ. So in other words, to kind of do a cart before the horse sort of public offering, if you will, by doing crowdfunding, getting the several hundred investors, be they Title II or III, raise the money, do the operations, and then essentially just file paperwork, including the S-1. And no matter what you do, I understand you have to spend a lot of money on the professionals, and then literally be public. And then try to get market makers
That's a
involved.
technical question.
I love that question because that's usually my answer in response to, well, isn't it a pain in the neck to have lots of shareholders? And the answer is, well, for every negative for some people, there's a positive. The question was asked earlier whether or not that's a negative when you want to sell your business. If you want to go on a liquidity pathway to getting onto an exchange, yeah, you have to have 300 or 400 shareholders of record, NASDAQ versus NYSE. And that's meaningfully helpful for you. It doesn't respond to what your minimum share price has to be and other things, for sure. But from my point of view, since we have a lot of companies that want to get public, and there's a real issue as to whether or not they have enough shareholders of record from the exchange's point of view, by definition, this is helpful.
I'd like to say just one quick thing about that. If I were an issuer, I would love to have 1 million shareholders and all the information that they filled out on the suitability form when they bought the share. And I would also have their payment information, their ACH checking account payment information that paid for the share. So now I've got 1 million people. I know how much they make. I've got their checking account information. I think I would like to have 1 million shareholders if I were an issuer in that case. Next question.
As long as they don't all call you.
Yeah, right.
I did a DPO in 2000 for an internet company. We paid about $187,000 for the total offer. We had 4,000 qualified investors from various organizations. We couldn't raise the money for a number of reasons. One, there was the dot-com bubble that burst, but also without pre-qualifying the investors, they won't come. So you can talk about an affinity group, but going after that affinity group costs an awful lot of money.
The cost per acquisition is probably higher for certain types of companies than it would be for Sandra Bullock's next movie or Dale Earnhardt's next season or something like that, you know, or Twitter. Time or what? Yeah, or social media, yeah. So I think we're about 12:30. I told them we'd quit. Any more? One last question? Nope, I guess that's it. Thank you, gentlemen. Thank you very much.